Okay, now the good news is you don't have to pay attention to anything that we're saying. It's all on our websites. So write down our first website, which is dentistlawyers.ca. Okay, it's got 160 blog posts, journal articles, videos. It's all free. You can email us. We'll give you a copy of our 150-page ebook. If you have difficulty sleeping, pop that thing open. You're down and out. Our second website is our new venture. It's dentistlegalforms.com. Everybody talks about letters of intent, wills, powers of attorney. Well, in fact, you can go on our website and create a letter of intent on your own. It's using our online automated software. Very cool stuff. So, first off, we're going to talk about selling shares of your professional corporation. So, hands up those who have a PC. Okay, most of the people in this room have a PC. Do you understand the benefits of selling shares of this company instead of selling the assets that this company own or which you own? Hands up if you already get it, and we can skip this part entirely. No hands. Wow.
I don't see any hands.
Okay, so basically a company, it's a separate person. Lawyers generally create it with accountants' help. It's a separate person. Could be standing right there. You own that person. That person owns your dental practice. What you want to do to save a lot of money on taxes is sell the shares, the ownership of that person, instead of just selling the assets, the chairs, and the equipment itself. And the reason, I'm sure David is going to get into it, is because of something called a lifetime capital gains exemption. The idea is every person in their lifetime gets a certain amount of money that they don't have to pay tax on when they sell shares of their professional corp. Normally, let's say you bought your shares for, I don't know, $1 for simplicity's sake. And some buyer comes and says, I'm going to pay you $100. There's a $99 gain, and normally you'd pay tax on that. You cut that number in half, and you pay your full tax rate on the gain. Thank God the government said, we're giving you in your lifetime up to $750,000 where you pay zero tax on that gain. And David, I'm sure we'll get into it. It's going up to $800,000. The idea is you can save a lot of money. I think it's about $170,000 at its fullest. You can avoid paying $170,000 in taxes by setting it up.
So if you don't want to pay the money to the government, you can pay it to me. It's okay.
There are a lot of criteria that have to be met for you to be able to save all that money by selling your shares. There's holding periods, there's ownership restrictions, there's asset control tests, all on the website. I'm not going to bore you with the details. One thing that comes up is dentists who are not incorporated say, what do you mean I have to own the shares for 2 years before I can sell them to take advantage of this thing? That's true. However, there's an exemption to the rule, and it basically says if you're not incorporated, don't incorporate yet. Incorporate and then transfer all of your dental practice assets that you own personally to this person, take back shares, and sell your shares all on the same day, all on that one day of the sale, right? So you can avoid having to hold on to these shares for 2 years, because that's the normal rule. You want to take advantage of this lifetime capital gains exemption, hold those shares for 2 years. If you're a dentist, you're like, I want to sell in 6 months. Do I have to do this and wait 2 years? No. You can transfer the practice assets, take back shares, and sell them all on that one day, the closing day, and you can still qualify.
Do you know the best part of what Michael's telling you? You get to make a phone call to your accountant. At the end of the day, and you'll likely hear something from David Chong-Yan, who's in the audience with us today, and he'll be speaking after us. Very smart, very experienced. Talk to your accountant when dealing with these issues. The lawyers will be here for the paperwork. The lawyers will be here to assist you. But at the end of the day, your accountant will also be very valuable and instrumental in helping you with this financial plan.
Very true. The good part is you don't have to wait 2 years. The bad part is if you wanted to multiply the lifetime capital gains exemption, if you want your spouse to also be able to sell his or her shares and take advantage of all that tax savings, they would have to hold on to their shares for 2 years because they're not transferring assets in. It's typically the dentist. Make sure your minute book is set up properly and is organized and up to date. We had a dentist come to see us and he said, I think this wasn't set up properly because my wife was given a type of share that doesn't qualify. And we looked at him and what did we say?
You're in trouble.
Yeah, so we cleaned it up, but make sure that it's set up properly because, again, that 2-year waiting rule will apply to the ownership of the shares. There was also a case that went to court where a minute book was not set up properly, and the CRA challenged them and said, you didn't qualify for the lifetime capital gains exemption because you didn't hold your shares. And the party that was trying to sell the shares, wasn't a dentist, said, well, we messed it up at the beginning, but then we found out about it a few years later and we fixed it. And luckily for them, the court said, yes, once they found it, they corrected it. They should have corrected it and had it proper at the beginning, so we're going to let them take advantage of the lifetime capital gains exemption.
To tie all this back into the topic, which is really how to maximize your value in a transition. So aside from the one or two buyers in the room, as the seller, how do you maximize your value? You're going to get, whether it be a letter of intent or some pushing from the representatives of a prospective purchaser, they will, for their own tax considerations, likely want to push for perhaps an asset purchase as opposed to a purchase of shares. Now, every deal is different, but in terms of general guidelines, a purchaser wants to buy assets. The sellers, which in this market you heard, at least in the GTA, is hot, hot, hot. There's a little more leverage with the sellers. You're going to want to look at selling shares. That's how you maximize value. On top of that, because dentists and also physicians as well are very privileged in terms of the government rules on how they can set up their professional corporations. Lawyers and accountants don't get the same privileges as physicians and dentists. Same things with the other regulated health professionals. It's just, the dentists and physicians. You guys, if you set up your corporation properly at the beginning, you'll be set up for the potential to either save a lot in taxes or maximize value when you go to sell. So again, it's important to speak with your accountant, speak with your lawyers, have that set up as you're going into the transaction and not scrambling at the last minute to try to get this done because you might not have it available to you at that time.
Okay, so are we, yes sir, you had a question.
When you're saying setting up this corporation properly,
yeah.
You're suggesting that there's different ways to set it up?
I've got this one. Do you have a niece? Do you have a nephew? Do you have grandchildren? Do you have grandparents? If the answer to any of those is yes, you might want to give them some shares and maybe try to do some income splitting or try to give them some benefit from the company, get some money into their hands. Is that permitted? Well, there's rules in terms of who can be a shareholder of a professional corporation, and it's limited. And in the case of dentists, you're looking at parents, children, spouses. And even if you maybe have a niece who you help provide for university for some reason, or you just helped raise that isn't really a child of your family that you've, at least it's been set up that it's a child. We'll worry about those laws after. But you have to make sure you have the right shares to the right people. Also, you don't want to fall offside with the RCDSO. The RCDSO has rules as well, because if you have a corporation, you'll need a certificate of authorization to practice dentistry through this corporation, and the college will give that to you if it's set up improperly. Other things, a professional corporation can only practice dentistry and things related to or ancillary to dentistry if you don't have a restriction set out in the articles of your corporation, and these things are set out on our website, you can be offside. So setting it up properly, you have to take all these different factors, rules and regulations into account.
Yeah.
Now, what is going to happen to the purchaser when you sell the shares of the professional corporation? Can the purchaser get those shares and transfer them to his own professional corporation?
Normally what happens is the purchaser will have their own corporation, buy the shares, and then after the deal finishes, combine their company with your company, change the name back to their name, and then proceed on that basis with an amalgamated company. So they will end up owning shares of an amalgamated company. Their company plus your company combined. Does that answer your question? Yes.
And if the purchaser is not incorporated?
Then they've received some bad advice. Because in order to finance the deal, it's much better for them to have been incorporated.
From the bank standpoint?
From their standpoint, yeah. And also entering into agreements personally, not as good as entering into agreements through a corporation. So there's tax, there's liability, and there's control issues.
And at the end of the day, you've heard from the speakers already, every deal is different. People have their own circumstances. Your own personal, financial, and family circumstances will be different than probably everyone else in the room. You're going to find a buyer or potential buyers that will have their own set of circumstances and receiving their own advice from their advisors. So you may not always be faced, if you're selling a practice, with a company looking to purchase. Someone might want to purchase it in their own name, but that's their advice, not your advice.